Welcome to Talk Tickers. This is the show for the experienced investor. We aren't here to hold your hand, and we are definitely not here to just, read you the press release.
Because that's designed to hide the real story. Our job is to find it.
Exactly. Today, we're digging into ticker NTR, that's Nutrien. We're looking at their Q3 2025 earnings. And honestly, my first reaction when I see a company talking about strategic reviews and asset shutdowns, it usually smells like desperation.
Right. The old shrink to survive playbook.
Yeah, like management's lost the plot. But I spent the morning with this deck, and this feels different. It doesn't feel like a retreat at all. It feels more like a boxer cutting weight before a title fight.
That is the perfect analogy. I'd frame this whole quarter as a fundamentals plus portfolio sharpening moment. You have the core engine just performing incredibly well, but you've also got management making some very cold, very calculated moves on the assets that aren't pulling their weight.
And the market seemed to sniff that out pretty much immediately. Yeah. We saw the stock pop, 1.5%?
About 1.5 to 1.8% right after the print. It wasn't a moonshot, but the vibe was definitely constructive. Bullish to neutral, let's say.
It felt like the street looked at the beat on the bottom line, saw the strategic action, and just sort of nodded and said, okay, we like where this is going.
Critically, it wasn't a sell the news event. The volume was up and the price held. That's the market validating the turnaround story. But before we get into the complex stuff, the Phosphate review, Trinidad, we really have to anchor this in the numbers.
Right.
Because honestly, they put up a scoreboard that's pretty hard to ignore.
Let's do it. Let's unpack those headlines. Adjusted EPS came in at 97 cents. The street was looking for 95. So a solid beat. Mm-hmm. But the top line is where I think it gets really interesting. Revenue landed at $6.01 billion. Consensus was way down at $5.7 billion. That's a 12% jump year over year.
And here's the nuance people miss. In commodities, revenue can jump just because prices spiked. Inflation, that's not what happened here. This was a volume story.
They moved more product.
They moved a lot more product. Moving 12% more top-line revenue in this environment is some serious heavy lifting.
And if you look down the income statement, the adjusted EBITDA, which is really our proxy for cash flow potential here, it hit $1.4 billion. That's a massive 42% jump.
Just think about that math for a second. Revenue up 12%. EBITDA up 42%. That is the definition of operating leverage. It means for every extra dollar of sales they brought in, they kept a huge chunk of it as profit.
They aren't just selling more, they're selling more efficiently.
Exactly. And the breakdown of where that money came from really tells the story. Potash was the clear winner. Sales hit $1.12 billion, up 27%.
Phosphate was up 20%, and even retail, which, let's be honest, has been the absolute bane of their existence lately, saw its adjusted EBITDA jump 52%.
That retail number is significant. It shows resilience, cost discipline. We'll get to that. But the headline here is really that this was a volume and pricing quarter, specifically in potash.
Okay, so let's dive into that. Segment 1, the potash powerhouse. This is the core engine. And they didn't just post good numbers, they raised guidance.
They did. They raised the full year 2025 potash sales volume guidance to between 14 and 14.5 million tons. That is a lot of fertilizer.
So you have to ask yourself, why? Why are farmers suddenly backing up the truck for potash? Is it just sentiment?
No, it's physics. It all comes down to what we call the soil nutrient drawdown thesis.
Okay, break that down for me. Assume I don't have a degree in agronomy.
It's actually pretty simple. We just had record crops harvested in North America. When you grow a massive corn or soybean crop, those plants are like biological vacuums. They just suck potassium and nitrogen right out of the soil.
So a record harvest means you've aggressively depleted the soil bank.
The bank account is deeply overdrawn. So to grow the next crop, the farmer absolutely must replenish those nutrients. You can't cheat biology. If you don't put the potash back in, your next yield just crashes.
So this demand isn't discretionary. It's structural. It's a biological necessity.
Exactly. And looking ahead to 2026, management is projecting global shipments to hit 74 to 77 million tons. If that holds, it's the fourth straight year of demand growth. We're getting back to the trend line.
And this is where it gets really interesting on the supply side. It's not just that farmers need it, it's that there isn't a lot of it sitting around. They flagged that channel inventories are low, specifically in China.
That was a critical detail in the call. Port inventories in China are down by over 1 million tons year over year. That is a massive hole to fill.
And China's the swing buyer, right?
Yeah.
When they step into the market, They move the needle.
They move the global price. So you have a situation where supply is tight, inventories are drained, and the biological need for the product is at a peak. That is a recipe for pricing power. They are not selling into a glut, they are selling into a deficit.
Okay, so potash is humming. But now we get to the second part of this deep dive, which is the transactional move. This is the news that probably got the ARB desks at the hedge funds really excited. Management officially launched a strategic review of the phosphate business.
This is that portfolio sharpening I mentioned at the top. To understand why, you have to look at the contribution. Phosphate is only about 6% of the company's EBITDA.
Just 6%.
Right. It's profitable, sure. But is it core to their long-term free cash flow story? Management is clearly signaling, maybe not.
It feels like they're directly addressing the conglomerate discount.
That's it exactly. Investors hate complexity. Nutrien does potash, nitrogen, phosphate, and retail. It's a lot of moving parts. By basically putting a for sale sign on the phosphate business, they're asking, do we really have a moat here?
And in potash, they do. In phosphate, not so much.
They're just another player in phosphate. They have a massive moat in potash, the best mines in the world. So they laid out the options, reconfiguration partnerships, or an outright sale.
And that list of options is a classic capital allocation signal.
Yeah.
They're telling the market, they're pruning the portfolio to focus on where they have that structural advantage.
Which is the potash scale and the retail footprint. If you're an investor, you love hearing that. It means they aren't just empire building for the sake of it.
Most CEOs want to run bigger companies. Nutrien's saying, we might shrink revenue to increase returns.
Which is the ultimate sign of discipline. Speaking of which, let's talk about the problem children. We have to cover Trinidad and the Brazil retail turnaround.
Okay, let's start with Trinidad. They completed a controlled shutdown of the nitrogen operations there.
Yeah, and the reason is pretty straightforward but frustrating. It's uncertainty about port access and, more importantly, a lack of reliable economic gas supply. You can't make nitrogen without natural gas, and if you can't get it at a price that makes sense, the plant is just burning cash.
That sounds ominous, though, shutting down a whole national operation. Is this a major financial blow?
Surprisingly, no. And that's why the stock didn't tank on the news. Trinidad is currently less than 1% of consolidated free cash flow. So financially, it's a rounding error. Operationally, though, it's a headache.
So they're just not going to run a plan to chase volume numbers.
Exactly. They said they aren't turning it back on until the economics make sense. Pure discipline.
Okay, then there's Brazil. This has been a sore spot for a while. How is that improvement plan going?
It seems to be tracking, but it is painful. They're closing 54 unproductive locations. They've cut 700 people from the headcount. They've idled 5 blenders. This is a gut renovation of the Brazilian business.
Wow, 700 people is a lot. That's a heavy restructuring.
It's painful, but necessary. The number one priority right now is credit collections. The Brazilian farmer is facing really tough economics, so Nutrien has to be so careful about who they lend to.
So is there any light at the end of the tunnel there? Or is it just a money pit?
There is a green shoot. Despite the tough farm economics, fertilizer imports into Brazil actually rose 2%. So the demand is there. Brazil feeds the world. They have to plant. Nutrien just needs to serve that demand profitably.
Okay, let's move on to our fourth segment. Operational discipline and leadership. This cost-cutting mindset seems to be company-wide.
It is. They had a target to cut $200 million in costs by 2026. They hit it a year ahead of schedule. That flows directly to the bottom line. On top of that, they lowered capex by 10% year to date.
And that's money that can go back to shareholders. But first, there was a changing of the guard announced in retail. Jeff Surumi is stepping back.
And Chris Reynolds is stepping in. He's a 22-year veteran of the company.
So he's not an outsider brought in to slash and burn.
No, he's an insider. He knows the plumbing of this company. He knows where the bodies are buried. Markets generally like internal promotions for these roles. It suggests stability and deep institutional knowledge.
So what does this all mean for the investor? Let's connect the dots. We have cost cuts, volume growth, asset sales. How is capital being allocated?
Well, they are buying back stock ratably, about $45 million a month, like clockwork.
Yeah.
And if you combine the dividends and the buybacks, the total cash return to shareholders is up 42% year over year.
A 42% increase in cash returns, that's a very shareholder-friendly statistic.
And they're paying down debt, too. They're targeting a leverage of 1.5 times adjusted net debt to EBITDA at mid-cycle. It's about building a fortress balance sheet.
Okay, so the So what, for the listener, what is it?
This is becoming a story of free cash flow quality. By potentially dumping phosphate and shutting Trinidad, the earnings that remain are higher quality and less volatile.
Quality over quantity.
Precisely. You're left with the potash engine, which has massive margins and a leaner retail business, and you have pricing power. The company is proving it can move volume even in a complex macro environment.
And you got that global context, China's export restrictions, tight ammonia markets. These things put a floor under pricing.
It's a compelling setup. You have the internal self-help story colliding with an external market that is tightening up. That's the convergence you look for.
All right, we've covered the fundamentals, the strategy, the macro. It's time to shift gears. Let's move into our not financial advice segment.
My favorite part. But first, the disclaimer.
Absolutely. Listen closely. This is absolutely not financial advice. Do not trade on this. It's for entertainment and educational purposes only. We're just two people talking into microphones, but let's imagine we're in that hedge fund investment committee meeting. Glass walls, expensive coffee. You're the analyst. I'm the PM. Pitch me the trade.
Okay, here's the pitch. I'm calling it the phosphate breakup arbitrage, or if you want a fancier name, the soil depletion super cycle call.
I'm listening. What's the structure?
The structure is you go long Nutrien and you short a generic materials ETF to hedge out the sector risk. Or if you want to get aggressive, you look at a leveraged call strategy targeting mid-2026.
Walk me through the logic. Why mid-2026?
Because the market is underpricing the cash injection from a potential phosphate sale. Think about it. They're selling a phosphate asset when China has restricted exports. Supply is incredibly tight. That means those assets are trading at a premium.
So you think they get a rich valuation for it? A bidding war, maybe?
A bidding war is entirely possible. So they sell the business, they get this giant pile of cash. What do they do with it? That's the kicker.
Aggressive buybacks or a special dividend?
Exactly. But here's where the supercycle comes in. That cash injection event hits right as the 2026 soil depletion narrative becomes reality. Remember, we said 2026 is forecast to be that massive replenishment year, 77 million tons.
So you are betting on the convergence of a portfolio cleanup event, the sale, and a cyclical demand spike.
You got it. It's an event-driven play masquerading as a fundamentals play. The market sees a boring fertilizer company. I see a company about to unlock a massive chunk of capital right into a demand upswing. It's a double-barreled catalyst.
That is aggressive and plausible. Yeah. I like it. But again, to our listeners, please do your own diligence. That is just a hypothesis.
A fun one, though.
Definitely. So to recap, Nutrien delivered a beat with 97 cents in EPS. They raised potash guidance, and they put the phosphate business on the chopping block to streamline the company.
They're getting leaner and focusing on their biggest lever, which is potash.
So the question for you, the listener, is this. Do you believe that return to trend demand story for 2026? Or will farmer economics cap the upside? That's the bet you have to weigh.
It always comes down to the farmer's wallet.
Thanks for listening to Talk Tickers. Do your own diligence, check the numbers, and we will see you on the next print.